Well, welcome back, everybody. Russell Gray, co-host of the Real Estate Guys radio show, here again with my good friend, Dana Samuelson. Hey, Dana.
Hi, Russell.
We are continuing to power through our series, Everything You Always Wanted to Know About Silver, but didn't even know to ask. And this was born out of my own journey, being fairly naive but aware of precious metals. As a coin collector, as a kid, I saw the silver come out, and it kind of had a lifelong fascination with metals, but I really didn't pay too much attention to it as an investor, especially as a strategic real asset investor, until after 2008. And then after that, it began to be a way for me to track what I thought was going to happen in the future. And then it became a way for me to hedge against the falling currencies. And of course, when you see the Fed expanding its balance sheet like it did in 2008, and now what it's doing in 2020, any prudent investor's got to look for serious ways to hedge. And I think that precious metals can be a real opportunity. There's a lot of talk out there about gold, but silver's a little bit different. In this module, we wanted to talk a little bit about the gold-silver ratio. We talked about it a bit in the last one, but I think, Dana, it's important for us to delve into it a little bit. So just by way of a reminder, can you give everybody a quick overview of what the gold-silver ratio is?
Yeah, it's simply a value measurement of one metal against the other. And all you need to do is divide the gold price by the silver price to see how many units of silver it takes to equal 1 unit of gold. And for most of 2,000-year history of man, it was 20 to 1. And since the 40s and 50s, it's been in a higher level, 40 to 1. And in modern era, it's been 60 or 80 to 1. Since 1995, we've been measuring the ratio, and it's pretty much been between 60 and 80 to 1 with an occasional extreme. Today, because of what's happening in the markets with gold leading, the ratio is skewed higher. It's about 95, 96 to 1, which means that silver is simply undervalued relative to gold by at least 15% in my mind. At this gold price of about $1,800 an ounce, silver ought to be $21 or $22 an ounce and not $18.50, which is where it's at today.
You know, for me, understanding what it meant and then how to act on it. Here's how it kind of went down for me. I went back and I looked kind of at the original structure that was put in place when gold and silver were designated as money in the Constitution at the beginning of the founding of the United States of America. And I think the ratio was about 15 to 1, as I recall. And so it was set that way for a long, long time. So the dollar value of precious metals was basically controlled. It wasn't about supply and demand because it was really just fixed. And so you could take your silver, you could take your dollar bills, your printed money, which were really coupons, and redeem them for specific amounts of real money, which was metal. In early segments, we talked about the difference in currency and metal. They used to be one and the same, or currency and money, but then they got separated, metal being money and paper being currency. They used to be the same, now they're apart. There used to be real metal in the coins so that the coins could act as currency, but they were also metal, and now they're apart. So if you don't understand that, go back and look at I think it was our first module in this series, and get your mind around that. But the ratio between the two metals is really what the gold-silver ratio is about. And so it tells you how expensive one is relative to the other. So if you look at silver as dollars and gold as whatever it is you want to buy, like a house, when it takes more dollars to buy the same house, it feels like the house is expensive. So if it takes 100 ounces of silver to buy an ounce of gold, you could say gold is expensive. Does that make sense, Dana?
Yeah, of course. Mm-hmm.
And then when the gold-silver ratio falls to, say, 50 to 1, then gold is on sale.
Right.
Relative to a price you got used to at 100 to 1. So when you recognize that, you can say, okay, I may want to trade back and forth. I mean, people who are trying to maximize their dollars, they will buy and sell gold and silver against that ratio, and they'll move in and out as a way to create more. And they're always in the metals.
Right.
They just make a pit stop through the currency. So they'll say, oh, my gold is at is worth 100 ounces of silver. So I'm going to sell my gold and I'm going to buy a bunch of silver. And then when the silver goes to 50 to 1, and I'll turn around and buy a bunch of gold. And it's a way to accelerate the amount of precious metals holdings you have. But in order to conduct the trade, you got to move in and out. And there's some friction in that you need to be aware of. So it's not as plain Jane as day trading stocks. So I'm not recommending that. I'm just saying that's the way some people use the ratio.
No, but there are arbitrage opportunities of one metal against the other when the ratio goes to extremes, like you said. And with today's ratio at 95 to 1, silver is clearly lagging, and gold is much more valuable relative to silver than it normally is at a 60 to 81 average range over the last 25 years. So at this point in time, silver is definitely undervalued, and it looks like a steal to me.
Yeah, well, again, we're sitting here in 2020, and there's another thing to think about. So we're sitting here in July. This is July 8th, 2020, when we're recording this, and the principles are the same. So if you're watching this and the prices are different, it doesn't matter. It doesn't matter what the prices are. Just get the principles. But we're sitting here in July of 2020, and gold is at, 18 something, 1850, and what is its all-time high in dollars?
1911.
1911, and that was in 2011, right?
Correct.
Okay, so it's been 9 years since gold has been at its all-time high, and it is now flirting with it. It's less than $100 away.
Right, that's exactly
What
right.
is the all-time high in silver?
It's been $50 twice, basically. In 1980, it hit $50 an ounce, and it hit it hit $49.75 an ounce in 2011.
And what is it today?
1850.
Okay, so just on that alone, it tells you that silver is probably the better bargain.
Oh, completely.
Right? Because you've got a gold to silver ratio that is very high, close to 100, and you have silver in terms of its dollar price, at 1/3 of its all-time high. So it's got a lot of room to the upside just to get back to where it came from. But you have to ask yourself, well, why would that be? Well, it could be because gold has caught a monetary bid, and it has. Central banks, who are the ultimate insiders when it comes to currency. I mean, they're the issuers. If you believe in looking at what insiders are doing because they have knowledge you don't have, like stock trading, and you say, oh, what are the insiders doing? And then you follow what the insiders do because you presuppose, and you're probably accurate, they know something you don't know. And then you do what they do. That's not a bad trading strategy, right? If you're into that. Well, think about central banks right now. When it comes to currencies and the future of currencies, who are the ultimate insiders? It would be the central banks, because they issue the currencies. They know how much they're printing. They know better than anybody. And they've been loading up since in the last couple of years, especially, more gold onto their balance sheets than they had, my understanding, since the dollar collapsed in 1971. Is that right, Dana?
Yeah, I have a chart that I can share with you. I don't have it immediately right here, but if you go back,
send it to me and we'll put it in the notes.
Okay, if you go back to 1970, I believe, the World Gold Council has put together how much net central bank buying or selling of gold there's been since then. And over the last 50 years, central banks have been net sellers for most of the 40 years from 1970 to 2010. Since 2011, they have been net buyers of gold.
Wait, now let me go back in time. What happened in that time period? The Federal Reserve, in response to the 2008 financial crisis, from 2008 to 2012, took their balance sheet from 800 billion to 4.5 trillion.
Right.
That is a huge multiple.
Right.
And what that's code for those of you that don't know, it's very simple. The Fed purchases assets to put on its balance sheet by printing money. So what they do is they print the money out of thin air. Just go look at the transcript of Jerome Powell's appearance on 60 Minutes in May of 2020, and you'll see he admits, just like Ben Bernanke did before him on 60 Minutes, that they don't actually print it like with a printing press. They print it digitally. But they create it out of thin air. They just create this money out of thin air, and then they put it into circulation by by loaning it. And the way they loaned it is they purchased government bonds. And then the government or government-backed bonds, in this case, mortgage-backed securities, obviously treasuries. Now they're getting into corporate debt, student. I mean, they'll buy anything right now. And so they take these assets out off the market, which are IOUs from you, me, and everybody out there, and they put them on their balance sheet, and they put the money out there that they printed out of thin air. So if you understand that basic mechanism, you understand that when the Fed balance sheet went from 800 to 4.5 trillion, they put nearly $4 trillion of currency into circulation.
Just created out of nothing. Correct.
And in response to that, central banks did what?
They started buying gold around the world at record rates and unprecedented central bank buying rates for the first time in 40 years. And they've been consistently doing it every year since then.
So what's interesting about that is the dollar, since Bretton Woods in 1945, after World War II, we won World War II, the United States won World War II, had 20,000 tons of gold, had the big manufacturing economy, had all the weapons. We were obviously the dominant force. Nobody could mess with us. And we had no debt. Well, we had debt, but I mean, it was minuscule. I mean, it was a lot, but it was relative to our wealth. It wasn't, right? You can have a lot of debt, but if you have a lot of equity, your net worth is, we were in good shape. That's the bottom line. And so we use that positioning to get the world to say, hey, instead of using gold as the current reserve, as your reserve, let's use the dollar, because the dollar is as good as gold, and you can trade in your dollars anytime you want for gold. Nixon put an end to that in 1971.
Right.
Okay. So people were collecting dollars as their reserves. And aside from the big fallout in 1971, where they loaded up on a bunch of gold, and gold went from $35 an ounce to $850, and that was the last time the central banks loaded up.
Well, that's when we went into fiat money printing in earnest for the first time in the 70s.
Yeah, well, actually, it was the 60s, right? Lyndon Johnson's War on Poverty and his whole guns and butter program.
Right, but it got to a head in 71 when Nixon devalued the dollar twice against an ounce of gold, from $35 to 1 ounce of gold to 38 and then to 41, which eventually broke the back of the ability of the U.S. to back every dollar with an ounce of gold in Fort Knox, which is why we went off the gold standard.
It was because they had printed too many dollars and people were redeeming them. They were it was a run on the bank.
Right.
Anyway, so the central banks loaded up on a bunch of gold.
Right.
Well, then it was like, okay, everything's cool. And we reset interest rates to 20%. And we have been systematically lowering them to make the debt burden easier and easier. Just like if you continually refinance, you don't get rid of your debt, but you make the payment manageable, and you can grow your debt and have the same payment, pay the same debt. So we've had a lot of that going on. But then about a decade ago, we hit zero, and we can't get off that mat.
No.
So the response then from central banks when in 2012 was to begin to become net buyers. But when this financial crisis, which was the insiders knew, the central banks knew, because they were loading up on gold. Then the problem manifested in the repo market in September of 2019.
Right.
And then got buried in what has become the COVID-19 financial crisis. At least that's the way I see it. What do you think, Dana?
No, I agree. There were problems in the repo market last fall, and the Fed had to intervene and inject some money into the system because there wasn't enough. As the economies of the world contracted in 2019, it was outside of the U.S. first. You know, a lot of foreign money was coming into the U.S. to try and stabilize. And part of that was in the repo market. And it got a little out of control, and overnight rates spiked. So the Fed had to intervene, inject some liquidity into the market, which started QE again, basically. And now the whole economic closures of the COVID crisis have accelerated everything again.
And gold responded to that by going up. And it's been the #1 dollar denominated asset in 2020, right, in terms of growth.
Correct. It's up about, I don't know the percentage, but it's up about 12 or 14% this year in dollars, maybe a little bit more. but it's already at record highs in every other currency in the world virtually except dollars, because the dollar has been
But
strong.
it's flirting with it. And so we went down a rabbit trail, which was an awesome rabbit trail. And I think it's great context and everybody needs to know. But ultimately, you know, we're talking about the gold silver ratio.
Right.
So when the COVID-19 crisis crushed the industrial production, the industrial demand for silver went down, and
Right.
silver is created as a byproduct of other mining operations, and those mining operations have gone down because demands for other metals, zinc and copper, things that are used in industry have gone down, and so less silver is being discovered as a result of that. And so there's some imbalances that could potentially occur, and we're going to cover that in the next module. But for right now, I think that the overall picture here is building on this idea of the split personality that we covered before in the previous module about monetary versus industrial, about the gold silver ratio and how it can show you opportunities to focus your metal accumulation on one metal over the other, depending on where it's at. And again, this is the series on silver. And one of the reasons silver at this time that we're doing this series is so important is because the ratio is hovering around 100, which is historically very high. It already broke through 125 in the last several months, which was the first time it had ever been that high, ever. And yet it is still 2/3 below its all-time high in dollars, where gold is already flirting with its all-time high in dollars. So all those indicators tell you the GSR is something you should watch. Gold silver ratio is something you should watch, but you should also know how to act on it.
Right. Right. So if you go back, and I'll give you a 25-year chart that we can put in here also that'll show the gold to silver ratio since 1995. Every time it skews high or low, one way or the other, it always reverts back to the mean eventually. So when we get to these extremes, it creates real opportunity of an arbitrage, one metal against the other. And right now, gold is leading, silver's lagging. So it is undervalued relative to gold. It's the same kind of cycle we went through between 2009 and 10, where gold started to move higher in earnest from 1,100, 1,200, 13 up to 1,500, and silver lagged. It went from 8 to about 12 or 15. And then it took off from 18 to 49 in a real short period of time and played catch up with a vengeance. And I expect to see the same kind of spring-loaded trap in the silver price eventually occur this time around. It just hasn't happened yet. It may be a while before it happens, which just makes the opportunity for people who are aware of it, gives them more time to execute.
Yeah.
We're in that similar phase right now.
So pay attention to the gold silver ratio. Now you know what it is. Now you know where it comes from. Now you know what it means and how to act on it, so that you can get more bang for your buck as you're converting some of your liquidity, some of your liquid assets, your cash, into another form of liquidity. Which is precious metals. You can always pivot back into dollars at any time. There's always a bid on both the metals, not just in dollars, but in other currencies. And so if for some reason the dollar were to fall out of favor and you decided, hey, I'd rather own yuan, or I'd rather own euros, or I'd rather own, you know, whatever currency, yen, whatever it is, you're always going to be able to pivot. So I think of precious metals as kind of home base, a place where you can park liquid wealth and pivot wherever you need to go. And it's highly liquid, and you can borrow against it, and you don't need to qualify for the loans. I mean, there's just a lot of advantages to it. So any closing thoughts before we wind down this module, Dana?
No, I think we've covered it pretty well. Thank you, Russ.
Okay. All right. So that's wrapping up everything you always wanted to know about silver but didn't know to ask gold silver ratio discussion. In our next talk, we're going to talk a little bit about the cost of production, because the price of something is based not just on supply and demand, but also cost. And so we'll talk about the relationship between all those in the next module. So stick with us. Hey, thanks for watching our silver investing series videos. We hope you're getting a lot out of them. Before you go, 3 things. Number 1, subscribe. When you subscribe, you build up our subscription subscription base, and that helps us reach more people. But even more important, it helps us attract great guests and subject matter experts to share their ideas and information with you. Number two, click that notification bell to make sure that when we do post a new video on this hot topic, you're notified right away. And number three, share. Please share this information with friends, help them get on board this bus, help them protect and preserve their wealth to take advantage of what's going on in the world today. All right, thanks so much, and we'll see you in the next video.